All right. Well, we've got an absolute firecracker panel here. We've got Fred Krueger, James Lavish, and the Peruvian Bull. Combined, they got 65 plus years of institutional investing experience. So we're going to go through the difference between risk on and risk off and what Bitcoin is currently. So we'll start it off at the beginning. Institutional investors and traditional hedge funds really hated Bitcoin initially. They didn't really understand it. Now, I want to start off, why do you guys think that was the case? Why initially they hated Bitcoin and, pre-ETF, why there was so much disdain for it and didn't really get into it?
Well, first of all, I think that we have 65 years of investing experience with just Fred and me, so it's going to be a lot more than that on this stage. But investors in the institutional world, it's not that I don't think they hated it. I think they just didn't understand it. I mean, I'm a perfect example coming from the traditional world, having worked in hedge funds for many years, for close to 30 years. And there was a point in 2017, 2018, where I had some extra capital that I wanted to, allocate to something that was a little bit outside the realm of normal things, like not real estate or bonds or equities or something like that, or not even private equity. I wanted to do something different. And I heard about this thing, Bitcoin. And I was like, okay, Bitcoin, there's got to be something to this thing. It's trading at like $3,000, $3,500, and it feels real. There's something there. So as an institutional investor, what do? You go to the experts in institutional investing. You go to the research analysts, and you say, so I went to the tech analysts across the street, and I said, hey, what's up with this Bitcoin thing? Is there anything there? And they're like, oh, God, don't do that. Don't buy Bitcoin. Whatever you do, there's nothing backing it. It's a Ponzi scheme. It's only used by drug dealers and like human traffickers, and it's going to go to zero, so don't waste your money there. So thank you so much for helping me avoid investing in Bitcoin when it was $3,500. It was so helpful. But that was your typical response back in 2017, 2018 from Wall Street. And that really hasn't changed that much over the next number of years until this year. But we can talk about that more later, yeah.
Yeah, I agree completely with James. I think, look, it's amazing when I go back to my class of, Wall Street, which is kind of late 80s, early 90s, and I go, how many of us, I was part of this Liar's Poker, John Merriweather group, like really the top 20 people on Wall Street at the time, in terms of risk positions, and none of us really have, there's very few of us who have any interest or exposure to Bitcoin. And why is that? So I'm going to ask you, why do you think so few of us oldies have managed to have transitioned to this new world? I don't know.
Well, I can tell you what held us up for so long. It was simple: gold. And people who have been investing for a very long time, they think of risk off. They think of gold. I mean, that's the obvious risk off asset for the last about 5,000-6,000 years. So it's a simple thing when you're in our seats that to just look at something that's been there all along and just go along with what everybody else does. So
and let's face it, who is the number one spokesperson for gold in this entire world? We know who his name is. His first name is Peter. His last name is Schiff. Okay. Right. Unfortunately, he's also the number one hater of Bitcoin in the entire world. So, all of us who sort of said, well, maybe this debt problem is a Ponzi, blah, blah, blah. Well, we all got into gold, and now the number one spokesperson for gold, obviously he's defending gold like crazy, and that's Peter Schiff, and he's basically spending every 5 minutes telling you how never to invest in Bitcoin. So,
which is ironic, given the performance of these Bitcoin ETFs, when they were launched. BlackRock's ETF reached $8 billion in flows within 30 days. And gold, after 270 days, the best gold performing ETF, GLD, wasn't even at half that, with 7 times the amount of actual time passed. And I think there's this, another point to touch on here is the recency bias and, just the senility of the industry, right? The average pension fund manager is 63 years old, and the average mutual fund manager is in his mid-50s. And so for these people, the 40-year bond bull market and 40-year equity bull market has been all they've ever known their entire career. So, going long bonds, long TLT, long equities has worked so well. There's a massive resistance to trying something new like Bitcoin.
Which is really, I'll tell you something, James, you probably will remember this. I'm even a little older than James, if that's even possible. But it's in my day, equities were viewed as a second-class citizen to bonds. And no reasonable person would put 60% of their net worth in equities, okay? So I got to tell you, it's amazing to me that this religion of equities has just become it's like the Bible now.
Yeah, but why is that? It's because we got off the gold standard. So in 1971, you can start seeing how equities became so important to people because they're chasing inflation, right? So, and then you enter Bitcoin enters the conversation. And what does it do? Well, it's super volatile. Why is it super volatile? Because it's being adopted. It's a very young asset, and it's being adopted, but it's volatile to the upside. We can talk about that in a minute. But when you're an institutional investor and you've got something that's so volatile like that, you don't understand it, and you've got career risk around it. But let's just pretend, how this works. Let's pretend that you're an asset allocator in an institution, and you get your 100 hours of Bitcoin reading in, you watch your 1,000 hours of Michael Saylor videos, and you get it, and you're like, hey, you know what? I really want to allocate to this. And so you go to your CIO, and you say, this is something we want to do. Okay, so pre-ETF, this is how it would work. You would go to your CIO, your portfolio manager, and whoever was head of the investment allocation decision, and you would say, we want to allocate to this thing. Okay, you've got to get them on board. And then once they get on board, which may take 2 weeks, it may take 2 years, but you get them on board, and they go, okay, we can allocate some to this. Then the next thing you've got to do is you've got to get your general counsel in agreement. And the general counsel is going to say, okay, where are you going to trade it? I mean, we're going to trade with this Coinbase thing? Are you Kraken? What is Kraken? We're a pension fund that's got $17 billion. We can't be trading with something called Kraken, okay? So that's the second thing. Then the third thing is who's going to trade it? Who's going to settle it? And where's it going to be custodied? Are we going to hold keys? And what are these keys anyways? And what's a wallet? There's just so much going on here. And then if you even get to that point, they're going to say, where do we mark it? Do we mark it at midnight, 4 o'clock, New York time? Do we mark it London time? Where does this thing even get marked? So you've got to get through all of that before you can get a decision that says, yes, we can go ahead. And quite honestly, it's just too much career risk. You couldn't get there.
So I want to talk a little bit about incentives here, right? So I think if you look at, if you're joining a hedge fund like you were or a prop trader, your incentive is to take a lot of risk, okay? Because you're going to be paid, let's just say the formula when I was on Wall Street is you make 20% of what you make, right? So you pull in, my first year.
If you had an agreement as an arbitrage trader with Stephen A. Cohen back in the day, he'd give you 50% of that 20% that you were going to get. So you would literally know exactly what you're going to get paid that year.
Yes, that was my deal too, right? So, and when my first year at Greenwich, I pulled in $30 million in profit. Okay, I got 20%, so I got $6 million. You know what I mean? So, look, and that was 1992. It was a different that was when $6 million was actually something. Okay, so I got to tell you, that's the incentive as a prop trader. Now let's look at the incentive as somebody managing somebody else's money. Okay. So I was recently at my accountant's, and they were like, well, we're actually a really enormous business management firm now. We're multi-billion. And I'm like, oh, really? You've merged? Yeah, we've merged with a bunch of other business management firms. And I go, how much Bitcoin are you guys advising your, those multiple billions? Oh, we got a guy who's looking into it. And I'm like, okay, so zero, right? And they go, well, there's you. You have a lot of Bitcoin, but like nobody else. And they're like, well, and then it sort of occurred to me, why is it that they can't allocate to their clients? And it's very simple. Because if they put money in the stock market, right, and the stock market goes down, what do? They go, well, I'm sorry, it wasn't our fault. The stock market went down.
That's our benchmark.
That's our benchmark, right? Now, what if they put money in Bitcoin, but Bitcoin goes down, but the stock market does not go down?
That is personal suicide,
career
suicide.
So they can only stand to lose, maybe 5%. Like if they say, I'm sorry, I gave you $10 million from, so-and-so rock star, that your money in the man. Now there's only 9. What happened? The market's up. I know, but Bitcoin was down. Okay, you're fired. Next. So that's the math behind advisors. So they're looking at this. I could tell these guys all day, all night that the power law and Bitcoin goes up over a 4-year period, or whatever I want. If it could drop 10%, if it could drop 20% or 30%, which it can, right? Which it did when it was 53,000 2 weeks ago, right? That could be political suicide if they have more than 5% of their portfolio. So, unfortunately, that's the incentives right now when you're benchmarking against stocks. You are pretty much only going to be allocating slivers to Bitcoin, unfortunately. So that's, I think, where we are.
But we're already seeing like early stages of this change, right? I mean, we were talking about this before, that Jersey City's already started allocating 2% of their portfolio to Bitcoin ETFs. State of Wisconsin's also done that. Several other pension funds in other cities have done that. So we're in this early innings of this, maybe regime shift to see Bitcoin and Bitcoin ETFs as a potential small but a portion of a portfolio. And they're overcoming all these biases we talked about earlier. But I think the compounded annual growth rate of Bitcoin and the value prop of it is going to start crushing all these arguments against it. Because, watching this year after year, price appreciation with the 1-year bear market and then 3 years of slow bull market, it's going to be very hard long term with, early investors making extreme amount of gains for these later investors not to have a little bit
also,
of fear.
let's also frame this in their terms. From the point of view of an institutional investor or an advisor, this market started on January 11th of this year, okay? Bitcoin 2013 doesn't matter. It's like that they could not participate.
Yeah,
doesn't matter.
For all the reasons that I stated of that progression of getting the idea, researching yourself, and then getting it approved to actually happen in your firm. Well, every single one of those issues and those hurdles was completely eliminated with the ETFs. Immediately, they could just say, okay, we can buy it with the broker we normally use. We can settle it with that broker. We can have it custodied with that prime broker that we normally use. We know exactly where it's going to trade, how it's going to close, what the pricing is and what the mark to market is. It was all solved in an instant. What has not been solved? What has not been solved is exactly what Peruvian Bull is talking about here, where this is still a super volatile asset. It hasn't been very volatile the last number of months, but it's still super volatile. And so what hasn't been solved is them understanding the asset, and that volatility to the upside is actually a positive in an asset. So if you have super high volatility in an appreciating asset, that's actually positive.
I think most of Wall Street still views Bitcoin as like a levered QQQ play. It's levered tech, levered beta on, non-cash flowing tech stocks. And so if you're a fund manager, you can say, hey, like I can own Bitcoin, which is essentially what they believe is a levered tech play, or I can just own tech. And if tech retraces, right, you're just lose the rest of the industry that's also invested in very deep in tech stocks. They lose too, and your benchmark is not. It doesn't look as horrible as if you're just investing in Bitcoin.
I think we're making Brandon's job very easy.
Yeah,
here.
we are.
100%.
Our host.
Yeah. Yeah, I mean,
just
you guys
wind
are-
us up and let us
Hey,
go.
I'm just letting you guys rip, man. They came to hear you guys. But, you know, what you're describing over here, Peruvian Bull, it sounds like, you know, the institutional investors still view this as a risk-on asset, right? When the ETFs got launched, there was a lot of money that got dumped into it. But what's going to be that transition, or what is going to need to be, what's going to need to happen in order for it to move to more of a gold, like a more of a risk-off asset?
We're going to need to see consistent price appreciation, you know, during periods of risk off, you know, market turmoil, right? And we've already seen some rumor, like, you know, tremors of this in March of 2023 during the Silicon Valley banking crisis. Bitcoin started off the month around 22,000 and it ended it at 28,000 after some extreme volatility intra-month during that entire fiasco.
Yeah, it
and
became risk off for a moment. Yeah.
Yeah, exactly. And the same is true during the September 2022 gilt crisis. So
and when Trump was nearly assassinated, the same thing happened.
Exactly. So there are instances of it being like a knee-jerk reaction, risk-off asset, but I think we're still wanting to see a long, extended, you know, risk-off bull market beginning while the rest of the market is tanking. That would be like the signal that things have categorically changed.
And I think it's going to happen slowly, you know, like you're talking about. It's going to come with understanding. And as more institutions understand it, truly do, they get through all of this nonsense from mainstream media, you know, all of the, you know, the fear and the FUD, as we call it in the Bitcoin space. But once they start getting that understanding, you're going to start seeing institutions dip in just a little bit. And it's called, you know, it's called legging into a trade. And so you'll start seeing places like Wisconsin Pension Fund, which is this is a monumental shift for a pension fund like this, which is very traditional and very difficult to get to allocate anything that's alternative. So for them to allocate into Bitcoin was huge. And so, but they'll just take a little bit of a position, like 0.5% or 1%. But then they're going to stare at that position every single day, and they're going to have to do the work on it to decide, am I going to hold this thing, or do I want to blow it off my sheets because it's driving me crazy to see it there every day?
You know, I had this discussion with Jim Bianco. And, you know, Jim's been a huge critic, right, of these ETFs. And, you know, he was like, I've been a critic of Jim Bianco, you know. And so basically Jim's position is that only the most degen of institutional traders are retail, are buying these things, and no real serious guy is touching them, right? And they're going to flip them at the first sign of trouble. Well, you know, he's been wrong. They haven't been flipping them. They've been accumulating them. And to your point, James, if you look at these, you know, the IBIT, and you look at the accumulation, people have only been increasing their positions. 70% of the people who bought in Q1, 70% increased their position in Q2. Same firm increased their position. So you're legging into this trade. They're putting their toe in the water. They're seeing if the water's semi-warm. Now they're going to put their ankle in, and pretty soon they're going to jump in the pool, you know.
And then you're going to see a whole bunch of investors, institutional investors, just cannonball right into the pool because they can't stand it.
Yeah, and we're also, you know, we had that initial spike in flows in the first month or two of trading, right? In March, we had multiple days with $1 billion of inflows into any one of the, you know, large Bitcoin ETFs. But even now, with the trading, you know, coming down out of that March mania we had, we're still seeing multiple $800 million, $500 million flow days. And I think that that's evidence of this, you know, long-term accumulation that some of these whales are starting to take on.
Well, yeah, I mean, and it is always the comparison to the gold ETFs. What I think is really interesting is we've seen net outflows in the gold ETFs for the past 3 to 4 years, but the gold price has nearly doubled in the past 5 because central banks have been buying up gold, the physical asset. Do you think that that's going to be a transition anytime in the future where, you know, a lot of these institutions start to see the ETFs and see the value proposition of Bitcoin and then go for the real asset and maybe, you know, some sort of multi-sig key holding strategy?
Well, all right, so let's talk about that for a second. First of all, we have to make the transition from risk on to risk off. There's no question that Bitcoin has been the tip of the risk spear for the most part for the last number of years. And what I mean by that is that when you see the NASDAQ move, Bitcoin really moves, or it will often lead that move up or down, depending on what's going on with the money supply or what's going on geopolitically or politically in the nation, or with our deficit. But one thing that's going to happen is that more money has to come into the space, and that's going to take time, but it can happen quite quickly once you do get that effect of all these investors who are now jumping into the pool. But once it does get that critical mass, the amount of money that can move in and out of it without moving that price as much, that's really important, because at that point, investors are going to make that connection that finally, this is something I can allocate to, not just from my risk portfolio, but I need to allocate to it from the portfolio that used to be risk off. And what's that portfolio? The bond portfolio. And they'll finally start taking money from bonds and storing it in this true store of value, the hardest currency, the hardest asset in the world. That's when that shift happens, and that's when the entire world will change in investing.
The thing that I think a lot of people don't understand is really just the size of this of this fiat world, right? Everybody talks about the U.S. debt, right? But somebody owns the U.S. debt, you know. So there's $34 trillion. Well, China owns a little bit. They're selling it now, but you know what I mean. But like $34 trillion. There's a mirror, and which is where is all that $34 trillion? Well, that's $34 trillion of bonds that somebody owns, right? So there is so much paper out there. That's just U.S. Treasuries, okay? Then you start taking corporate bonds.
Yeah, there's about $140 trillion of investable bonds in the world right now.
Yeah, so
140 trillion in bonds alone. That doesn't count real estate. That doesn't count equities. There's another 300, another 120, and then you've got gold. There's $700 trillion plus of investable assets in the world.
Right. So basically, we really the big money is we're at the doorstep of the big money. We could see trillions of dollars, right? And I think that's what's changed with Bitcoin, because when we were looking at the last cycle, what did we have, right? We had VCs, we had Grayscale, it's kind of like this hobbled fund, that's like trying to promote Bitcoin versus drop gold, buy Bitcoin. This was sort of this, I'm not saying VCs are all second tier, but in terms of size, they are second tier relative to funds, right? Relative to BlackRock, right? Relative to Fidelity, so we are talking trillions, not billions here, right? And those trillions are warming up to Bitcoin.
The five largest asset managers in the world control over $30 trillion of assets. Just five. That's how much money is out there. And once those start allocating to it, then the whole game changes.
And I think, we haven't even brought in the geopolitical aspect, right? Sovereign wealth funds accumulating Bitcoin, foreign central banks accumulating Bitcoin on their balance sheet. Those are two other large potential buyers, which have historically been large funders of U.S. debt and also buyers of U.S. equities. As they see negative real returns on those debt instruments, there could be a massive regime change shift in saying, would we rather own, $50 billion of the 30-year Treasury, or do we rather put a portion of that into Bitcoin, which has extremely levered beta, obviously, and has debasement insurance essentially against this policy?
Look, and one of those things that wasn't even discussed until this conference was the United States being one of those countries, right? So, if you told me 6 months ago that a independent candidate for president was going to be advocating that we put, let's call it $4 trillion worth of Bitcoin, or sorry, not 4 trillion.
Buying 4 million Bitcoin.
Buying 4 million Bitcoin, right? Which I think, that will be 4 trillion when Bitcoin hits a million. But, buying 4 million Bitcoin, I would have said there's no way that happens. Let's see what happens in 2 hours, and let's see if Trump antes it up a little bit, right? I think he is. I think he's going to. Those are the table stakes, and I think he's going to ante it up a little bit. But I definitely think we are now at the point where we can start considering that the United States is going to do more than just hold these 200,000 Bitcoin.
Yeah, and that puts a target on, like I said, every single foreign central bank and every single foreign treasury's back. If the U.S. dollar, which is the underpinning of the entire global monetary system, if they're buying Bitcoin, if the U.S. Treasury is buying Bitcoin, every other treasury is going to start thinking, what are we doing if we're just holding dollars and not buying Bitcoin? If dollars are being debased and Bitcoin's being pumped as a result. And
that includes corporate treasuries. And it includes all pension and endowment and other institutions as well. It becomes that risk-off asset. It becomes a liability to not own it instead of where we have been, which is a liability to own it. And I pulled up some numbers this morning just to give you guys an idea of what the institutional money managers are looking at right now. If you had a typical 60-40 portfolio, and I just use the spiders and TLT, the 20-year plus bonds, but if you had a 60-40 portfolio over the last 5 years, you had a 7% annualized return. You returned 41%, over 5 years. Not terrible, but not great. Not in the world of inflation that we've had. If you just had 1% of Bitcoin, just 1%, you would have returned 45% in full, 7.8% annualized. If you had 5% Bitcoin, you would have returned 63% and 10% annualized. And then if you had allocated 10% Bitcoin, you would have returned 13.2% annualized for 86% over. You would have doubled your returns with just a 10% allocation to Bitcoin. And they're looking at this, and here's the crazy thing. The drawdowns that occurred during that time were not too different. They were between 28 and 35%. So you have the ability to add this incredible asset that now you've got nation states adding to their balance sheets. You've got corporate treasuries adding it to theirs. The institutions are going to have a wake-up call in the next few years, and that they don't own it, they're in trouble. They've already missed quite a bit of a move.
Long story short, no one is bullish enough.
Exactly.
You couldn't say it better. I agree. I think this institutional adoption is totally happening, and I just happen to believe that 5 years from now, even these views are not even going to be. They're not even going to be controversial. They're going to be wondering how it wasn't so completely obvious back in 2024. So.
Yeah, exactly. Everybody and their mother's going to need a Bitcoin strategy here pretty soon. But these guys have been absolutely outstanding. Why don't we give them a round of applause, and thank you guys all for coming out. Nice job, fellas.